So the election's been over. We know that there's gonna be a change in the presidency. Is this gonna affect the economy? Is it gonna get better, or is it possible it could get worse? That's what I'm here to discuss today with Frances Stacey. So tune in. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you. You work so hard for your money, and you're now ready for your money. Start working harder for you today. You want that freedom of cash flow now, not 30 or 40 years from now, but you want it today so you can live that life that you love with those that you love. But most importantly, guys, we know it's not just about getting rich, even though we love that too. And we want that time freedom and money freedom as well. But we want to live a rich life because as we were blessed financially, as we were able to grow and expand our resources, we now can be a blessing in the lives of those around us and create that ripple effect. Guys, thank you for allowing me to do that with you today. So appreciate it. If this has also benefited you in any way, shape, or form, please go to Apple Podcasts and leave us a quick review. Just say, hey, we love you, 5 stars, you're awesome. If you don't love us, then don't waste your time. It's cool, but love to get that review from you guys. So please do so and support us on this show because this ripple effect could not happen without those of you. Also, a special shout out to many of our own, really not just our own VIP clients, but I want to do a special shout out to my own team. They are the reason why this show even exists. I mean, granted, I'm the one doing the show, but I would not be doing video for one if it weren't for having a team because I don't know how to do jack squat. So the fact that they're able to get this out and be able to share this with you guys and create shorts and clips and just create so much content for you guys, huge shout out to my team because even though you don't see them, you see the effect and the ripple effect they're creating too. So thank you so much, team. All right, guys, so I'm bringing on Frances Stacey today. I'll tell you, when I first got introduced to Frances, it was actually we were on a panel together discussing the economy and things like that. And I'll tell you, like, she just resonated with me so much. Not to mention, she was the first one to comment, and she pretty much, I think, kind of created a gag on the rest of the group. Nobody wanted to comment after Frances because one thing that's amazing is that she actually predicted the last Great Recession. And so that got her really popular on social media and outlets, but she's great in the way that she sees the economy and what's coming up. We're not saying she's Nostradamus, but she has amazing insights. And I think she'll be very valuable for you guys to hear from because I wonder, just like you do, what's next? Because everybody's talking about the picture being extra rosy. Is that really the case? Is it really going to be this bright future? Or there's something we're not seeing yet? That's what we're going to discuss today. So Frances, welcome to the show.
Oh, thank you. Thank you so much for having me. And that panel was a complete blast. And it was so funny because it was like a total commercial real estate panel. And I like completely geeked out about the Fed. And so I'm glad it was well received.
Oh yeah. I mean, all you have to do is bring up Feds. I know, Big Mike and I, Zlotnick, I mean, we often will talk, in person all the time about that kind of stuff. And so it was, for me, I could have said nothing and I would have been totally happy. Just being a part of that panel was really fun.
Yeah, super. Yes, a ton of fun. Just to give you like a quick kind of background about me. Yes, you're right. I predicted and traded the global financial crisis totally on accident at the time. Didn't realize what I was tapping into. Was getting into trading. This is obviously many years ago, and I was just looking at those Great Depression technical charts, and I wasn't. I was able, just beginner's luck, I was able to filter out the noise from some of the other things happening at the time, and so I saw a very distilled picture. After that, I knew that I wasn't going to have beginner's luck twice, and that I needed to learn the system and learn the business cycle. So I sort of locked myself in a closet for a decade and studied the business cycle throughout, history and, going back with, the mechanisms of banking and debt and credit. I currently am the chairwoman for the Committee on Global Digital Finance. It's a UN committee. And so we are definitely talking about how government-wide, how you would integrate digital finance. We're working with El Salvador, which obviously, has Bitcoin as a legal tender. And it's just very interesting because mechanically, from a liquidity perspective, Bitcoin is very different than the US dollar, and those are their two legal tenders. And then I'm a wealth strategist and, wealth manager and economic strategist for a firm, Scarlet Oak Financial Services. I can't give investment advice on the podcast, as you know, but anybody's welcome to contact me, Frances at scarletoakfs.com. And I'm happy to have a conversation about your individual situation. So with that disclaimer, let's dig in.
Awesome. Yeah, you got those securities licenses. They don't let you say anything, do they?
No, I can't say anything. Yeah.
See, that's why you just got to follow my example and just drop it like I did in 2005. It was so liberating. It was amazing.
I know. Well, that's an off-camera story, but I am really happy when people contact me and talk to me about their individual situations because it is really fun. Of course, I'm great at solving other people's problems, and then I have my advisors for my own situations. So,
Yeah. And you said something I
yeah,
didn't catch earlier, but you mentioned that you were a trader, which I was as well, especially in the mid to late 2000s. And I used a lot of that technical analysis to kind of do my own predictions. But I don't know if you had the same experience I did. And maybe I'm just an idiot, but I had made several predictions based on the technical analysis I was seeing. And a lot of it did not happen. Like, for example, I actually did a blog and I was writing on this. I was calling it Y2K15 because I saw similar patterns to Y2K. And so I said,
yeah,
after 2015, going to 2016, we should have another correction in the market, and it went flat. And then, of course,
yeah,
when Trump got elected, it shot up that year. So it was down until Trump got elected. Then it went rallying back up, and I was like, well, there I was wrong. And then, of course, the end of 2019, I said, you know what? Looks like 2020. Everything I'm seeing, even the real estate space, everything looks like it's about to come to an end. And then, of course, with COVID and everything else, they started pumping out money like no other, and the thing rallied again. And same thing in 2021. I was like, okay, we've delayed the party. Here's the hangover, and it didn't happen. So I've been wrong a lot. And if anybody's followed my podcast, because we're now going into almost our 11th season at this
oh
point,
wow.
they're probably like, okay, Chris, we hear it all the time. So Francis, like, what's been your take? I mean, you've been watching this stuff. Did you see things similar to me? Are we just kicking the can down the road? And how far does this go?
So yeah, so like I said, beginners luck global financial crisis started trading and literally in February of '07, and as you know, the market high was in October of '07. So
Mhm.
yeah, I saw the same thing you did. I mean, I actually made a kind of a call on Fox Business at the time. Didn't have the securities license, and so I had a little bit more liberty as to what I can say. But
Yeah.
I totally was predicting a sell off. I'm like, look, we're at the 10-year mark, and I'm seeing all these cycles converge and stuff like that. And Trump did pass tax reform, and fiscal is one of the fiscal revenue and also how it's allocated is one of the things that's a determining factor in both GDP and also how liquidity moves around in the cycle. So I have definitely been wrong. And then of course, evolving into my securities license status, I've definitely I tend to ride the fence a little bit more now, and
Mhm.
just give the either or on it. But here's the thing. So yes, so what you're saying is so correct, right? Like every time we think we have a major cycle, we have technical signals, we just put more liquidity in the system, and then we do kick the can down the road.
Yeah.
The Fed started tightening, and in obviously we remember in 18 Christmas Eve, the market sold off pretty dramatically. They stopped with raising rates, but they still continued the balance sheet tightening through 19. And I was like, this is crazy. I was like, okay, so they're, that was surprising to me because the policy wasn't in alignment. It was contradictory. And then, of course, September of 19, you had this sudden shortage in the overnight markets when people started putting those quarterly tax payments through and, completely reversed course, right? Injected like $500 million into the system, and that was just before COVID. And then, like
Yeah.
you, totally calling for a sell off, with securities license in hand, but calling for reducing risk before COVID. And of course, we
Mhm.
got COVID, and yeah, the market corrected so far so fast. But then when the Fed came in and they did unprecedented things, backstopping the credit markets in such an unprecedented way, obviously there again. So now where are we? Like you're saying, is it all rosy? Well, the $100 trillion question, I think I've had to switch to trillions now, is do the mechanics of the debt cycle and the business cycle historically matter?
Mhm.
Or have they been altered? And my favorite analogy for this is you have the internal combustion engine, obviously the car, and then you have like Elon Musk's innovation with the Tesla. Driving a Tesla and driving an internal combustion engine, very different.
Yeah.
However, they both still have axles and wheels.
Mhm.
So, are we in the scenario where we're just electric carring it from the mechanics of the debt cycle and these mechanics don't matter anymore? The quintessential things around inverted yield curves and quintessential
Mhm.
predictors of recessions just don't matter anymore? Or are we in, yep, still got an axle and wheels, don't care who's the president, don't care, like we need liquidity to drive the system. I'm, call me nostalgic. I'm kind of in the axle and wheels camp, but it remains to be seen. And what that looks like is this. The yield curve, just to kind of review that, is obviously looking at the government debt and looking at the short-term maturity versus the long-term maturity across a curve. And when the yield curve is normal, the yields would be higher on the long end of the curve for longer term debt, because you'd be paying more, you'd be getting paid more yield to lock up the debt for, your money in the debt for a longer time.
It's like getting a higher yield on a 5-year CD versus a 6-month CD, right?
Exactly. So, but the Fed generally affects mostly short-term interest rates. And so when they start raising interest rates, which they did at a record rate, by the way, they start pushing up those short-term interest rates, and relative to the long end of the curve, it starts to invert. And that's not normal. Yeah. So what happens there is people say, oh, inverted yield curve, recession. Okay, so that's true. But if you go look at the charts, and Fred, which is a Fed source, has the best charts on this. If you look at these charts, historically, the recession starts when the curve starts normalizing and re-steepening. Okay, so we've had that occur very recently. It started to re-steepen because the Fed has changed its stance, and the yield curve has been affected by that. That's when the recession starts, because the Fed lowers rates in correlation. Perfect. Because the Fed lowers rates in correlation with unemployment. Usually it's responding to the labor market. I do think that the 50 basis point cut that Powell made, was correlating to some softness in the labor market, right? And like you said, anecdotally, you're hearing about friends losing jobs. So now what's interesting is that for the first time that I can recall ever, when he lowered the interest rates 50 basis points, yields went higher. So usually it's don't fight the Fed. So the bond market kind of bucked that. And it's because I don't know that inflation is completely finished. And that's what the bond market is pricing in, because commodities prices were still going up. And so they're kind of fighting, the bond market is fighting the Fed. So that's going to be an interesting catalyst. And now that Trump is in, you'll notice today that equities are moving higher, because, equities tend to do well in an inflationary environment. Obviously, different sectors do different things. But, the bonds are selling off because they're anticipating that his trajectory that he's laid out for, lowering rates is going to have to change in order to not have a big reacceleration in inflation. Okay, so back to the yield curve re-steepening and uninverting. Okay, so those mechanics are in play. Now, if you look at charts historically, it's the length of time that the yield curve was inverted correlates to the drawdown when it normalizes. So we were inverted for over 700 days, which we haven't been since 1929. So we know what the drawdown looked like in 1929. And again, do we have the same mechanics? Do we have modern monetary theory? It doesn't matter how much money we print as long as we can service the debt. Or do we have the axle and wheel scenario? So what happens now is it's uninverting. And usually there's a domino effect to this playing out. Yeah. Okay. And so the domino effect in preceding recessions, in the 90s, you had Kuwait and the oil situation. So that was the catalyst to tick that first domino. In 2000, you had the tech bubble burst. That was the catalyst to tick that first domino. In the global financial crisis, you had the housing bubble burst, attendant with several other things that occurred, and that ticked the first domino. So now what we have is we have the Fed, and globally, they're reintroducing liquidity into the system ahead of that domino. So it's a new way of thinking. They're not reacting to the domino. They're trying to preempt the domino.
Right.
So here we go with, how does that work? I was thinking that potentially if we had a contested election, which I was thinking was a decent probability, because I thought neither side is going to go quietly. We had a contentious election season. I was thinking that could be a catalyst to increase volatility and sell-off. Obviously, we have geopolitical things. So we just haven't had that catalyst. So if those mechanics are not broken, as soon as we get that catalyst, what are potential things on the table for that catalyst? Anytime you have to tighten as a reaction to inflation increasing, which is what's happening in the markets today, they're trying to price that in.
If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now.
You can take the future liquidity out of the system. You can't take the debt that came with the liquidity. So what happens is the liquidity drops below a threshold where you can't service the debt. You have a reaction in the credit markets. You have defaults. You have fear. That clicks that domino. Where are we vulnerable credit-wise? Okay, these people that are losing jobs, 60% of Americans living paycheck to paycheck with a record amount of interest rates paying on these credit cards, and record amount of money being put onto credit cards and things like that. Putting groceries and things like that on credit cards always, and whenever you use your credit card, that puts liquidity into the system. But the minute you can't service that debt, and what percentage of those people stop servicing that debt when unemployment does go up? Now, that's one. You have maturity walls both with treasuries. You have a maturity wall in CRE that's being, renegotiated. Those loans are being extended, probably because the banks don't want those buildings.
Yeah.
I think they call them jingle keys when they just send the keys back and stop paying the loans. So you have these sort of catalysts in the system. And then the question remains, number one, can Trump kick that can way, way, way down the road? And can Trump and Elon actually change those mechanics with the Fed and, preempt the recession?
Right. That's assuming the Fed wants to listen to them, because they're supposed to be independent, even though they're not Fed and they're really just bankers, right?
Yeah. No, it's a totally, it's a private, it's a private for-profit bank, actually. And it's as federal as Federal Reserve, but they have been given the authority by Congress to, enact their dual mandate, which is price stability and full employment. Now, in some seasons, there are 4 economic seasons, like we have 4 seasons in general with weather. Mm-hmm. And in some seasons, the dual mandate is contradictory, and some seasons it's not contradictory. So it just kind of depends. But that's the thing is, and going forward as an investor, as an allocator, and also, as somebody who advises, we look at what is the season and what season are we in now and what season are we going into. We look at the back tested data on how, sectors perform in those various seasons. And we look forward with new data as to, especially post-COVID, and where were the anomalies. And we just try to think with that to the best of our ability. And we don't try to, time the markets or time the election or trade around the election. We just try to go with those, steady as she goes kind of things, because we're dealing with people's retirement.
Right. Well, and then there's a comment I think I had made when we were on the panel, and I even did a podcast episode just about it, which came out a few weeks ago, talking about, what's going to happen to the election, will it matter? And I basically said, no, it doesn't. At least not from the presidential standpoint, more from your local representatives like Senate and your House representatives, which obviously that made some news, even though it wasn't as big news, but that made some news too, right? Where they supposedly are all now the same party. Although, history has shown too that even when they have a majority in the Congress and in the presidency, they don't always get crap done, right? There's usually some issues still.
Right. So no, that's totally true. And the thing that's interesting is that if you do look at historically, I mean, markets go up almost under every presidency, because again, the economy is always expanding. Like obviously the debt is expanding, and that's the liquidity that comes into the system, whether it's public or private debt, that expands the system. Mm-hmm. So election. Okay. Assuming, first of all, we have the White House going Republican. We have the Senate Republican. They're still deciding on the House. It's looking reddish. I think not to hype another podcast on your podcast, but I really liked Elon Musk's interview that he did on the All In podcast, because they really challenged him mechanically about, making these drastic fiscal changes and, what percentage he was going to do with that. And basically, he talked about changing the operating system. So they said on that podcast that with federal, state, local, all of the government spending, they were thinking that it was correlating to about 40% of GDP. Obviously, government spending is one of the components of GDP.
Yeah.
And they're like, look, if you just drastically reduce that, like he's thrown out there a 2 trillion number. If you just drastically reduce that, then, obviously that's going to pull a lot of growth and a lot of liquidity out of the system. And I can say that I do think that the high fiscal spending has been one of the things to counterbalance the record rise in interest rates at a record
Right.
rate to stave off the recession. And so it's going to be just very, very interesting about how mechanically, how draconian they are about the fiscal spending. And his
Mhm.
idea around that was like, hey, let's just change the operating system. He had a totally technological concept of this, which I find so fascinating. He just said, let's change this operating system from having to, do all of these government programs for these suffering people, and let's try to convert them into the private sector.
Yeah.
Uh, Easier said than done, of
Hmm.
course, but Elon has done some pretty impossible things. So I'm kind of excited, just may we live in interesting times. Like I'm just kind of excited to see what he really comes up with that mechanically. And I thought some of his stories about, the regulations that he's just experienced in his own company about like trying to get stuff done. It's insane. It's the regulations are insane. They are so, business prohibitive. And
Uh-huh.
so, just reducing those regulations and reducing that friction, but you have to do it in a way where you don't have a corporate takeover of the government and the lobbying. And
Right.
then you kind of put RFK in there for a little bit of balance on that point, because he's obviously litigated with all the health related agencies.
Hmm.
And man, it's going to be interesting to watch like what actually occurs with this administration.
Yeah, I totally agree. Well, that's kind of what I was wondering too, is that they could do some things, like you said, to kind of, kind of push the envelope a little bit more, right? They can kind of push this and delay it a little bit more. Because, like you said, I think the big thing you mentioned too, repeatedly, I kept hearing you say was liquidity, right?
Yeah.
Like I watched like the M2 money supply, which
Yep.
they're still printing money, they're still pumping money in the system. Therefore, banks
Yes.
still have liquidity, they still have money to give. It's like any one of us, if we had a credit card and then also the bank came to us like, oh, by the way, we're just raised your limit for the heck of it. Oh, you know what? We just did it again. You're like, oh, phew, even though I'm going broke, I can last a little
Yeah.
bit longer, right? And that's kind of
Yeah.
what the government's been doing right now, where we're seeing this happen real time. And as long as we're liquid, things work great. But I mean, even the GDP is when you look at the stock market in comparison, it's two standard deviations above the GDP. The last time that was Y2K, right? Right
Yeah.
when we saw that crash. So
Yes.
I find it fascinating that we're just like all the signs are saying like it's like red, like or even at least yellow for caution.
Yeah.
But like you said, if someone gets innovative in some way, shape, or form, that could still delay that down the road.
Totally. So this is what I'm watching just for
Mhm.
fun. I agree with you entirely. And the whole essence of modern monetary theory is as long as you're liquid and you can service that debt,
Yeah,
as long as you can make your minimum payments on your credit card, you look like you've got perfect credit. And and as long as
right.
they're willing to give you more and more and more credit, more and more and more credit,
Mhm.
obviously
Especially if
when
you're employed.
yeah, if you're employed, exactly. So that's so interesting. So what I think is a real challenge is that the United States is, if you take away the U.S. dollar, the status of the world's reserve currency, the
Mhm.
United States is close, starting to resemble sort of a third world balance sheet.
Yeah.
Now, that is so now you have the BRICS system. That's the economic system that is gaining prominence. They just had, I think, their 16th annual conference. They're gaining prominence. They're trying to gain critical mass. I think I spoke to someone in the UN today who said that Mexico's on the fence about that. Now,
Hmm.
if they gain critical mass, there's also, I've heard different things that, they're and none of this is super verified, but I've heard
Yeah.
things saying that, they could have they're buying a lot of physical gold. Obviously, foreign central banks are buying a lot of physical gold,
Hmm.
and they could offer a currency that's quote unquote 40% ish backed by gold. The other 60% is this basket of currencies. They're gaining critical mass with global GDP. And would that tip us away from using the US dollar as the world's reserve currency?
Right.
Mechanically, what does that look like? If that were to occur, and if you listen to Ray Dalio or study Ray Dalio, he thinks
Hmm.
that we are on the trajectory of this. If that were to occur, we don't have demand in our debt markets. So it's like if you're comparing it to the personal situation that you just did, it's like losing your job. It's like your credit card
Yeah.
debt is fine until you lose your job.
Right.
And then the house of cards completely falls. So I'm just so interested. And obviously the dollar went up today on Trump's win.
Yeah.
And again, like you said, depending on where the House, if we get a complete red wave and we get the House, they're going to be able to have more latitude to do more, moving pieces around, assuming that the establishment Republicans don't stop them.
Mhm.
And, depending on whether or not they need 60 votes in the Senate, et cetera. But they're going to have more latitude to kind of convert this system. And so obviously they're aware that the US dollar is losing prominence. That's not, and Powell himself has said, hey, our fiscal situation really isn't sustainable. So we just have to see how this plays out. And with clients, we just look at the various personal risks that they have, try to diversify it. We have these various liquidity buckets, so they don't get stuck in an illiquid position should things massively shift systemically. But that's the biggest threat facing America is loss of the US dollar as the world's reserve currency, because that would really change the demand in our debt. And what is the demand in our debt? It is liquidity.
Mm-hmm.
Yeah.
Right. You got to have that liquidity.
Yes.
Once we lose that, and that's why every time it almost seems like there's some sort of banking failure that happens that sparks a recession, isn't it? It's like something unwinds that it was too much of a party. Someone went just overboard. It created a little bubble, and we kind of witnessed an everything bubble in the last 4 years. So it's kind of interesting to witness.
Private credit, another shoe that could drop. Yeah, when the Silicon Valley Bank thing occurred, that looked like a potential catalyst for that domino effect.
It did.
But again, the Fed came in and came in with another facility. What was interesting about that, right? Because they had all of those unrealized losses on their balance sheets because basically they had those bonds and that was supposed to be Old Faithful and safety. That was supposed to be a really safe place to park your money. The treasuries and mortgage-backed securities, but they were getting paid only, 3%. And then obviously banks don't pay out, like money market funds do to depositors. But essentially it was setting up a negative income type scenario. And then when the Fed came in and gave them loans at par, but they gave them loans at par at the current interest rate, which was much higher.
Yeah.
They didn't give them a break on the interest rate. And we still sailed through because I was watching to see if that would work. And so, like you said, there's a lot of kicking the can down the road. The debate is out there for axles and wheels. I look forward in my capacity in the UN committee to really talk about governments, about fiscal liquidity, the mechanics in the digital currencies versus the mechanics in the fiat currencies, and can you change the debt cycle? Because the thing is if you change the debt cycle, like let's take an extreme viewpoint. Some people are like, hey, why do we borrow from ourselves at our own cost, right? Why do countries do that? Well, the reason is because if all of this government spending wasn't debt, it would just go like this forever, because debt has an elastic component. When it matures and comes off the books, it's pulled out of the system. Yeah. So the money supply, instead of just going up in a straight line, now is, there's an ebb and a flow to it. And that's what the Fed tries to manage. If you don't have the ebb and a flow mechanically available, it just goes like this. And that's discriminatory to every future generation because everything just gets more expensive endlessly. So that's obviously not workable.
Right. So what do you see is, like you said, you're asking your clients to diversify. What are you asking? And stay liquid, of course. So what are some places you're seeing as like safe havens potentially for people right now?
Well, quintessentially, right now we have to watch and see what occurs with growth. Growth is going to be correlated with fiscal spending because obviously there's a catalyst there. And then we have to see what happens with a reacceleration in inflation. So do we have stagflation? And there are things that work in a stagflationary environment. Or do we, come in and slash it's basically you have either growth is going up and inflation's going down, or growth is going up and inflation's going up based on a rate of change, acceleration, deceleration, or you have growth is going down and inflation's going up, or you have growth and inflation both decelerating at the same time. Right. And you have various sectors that perform in those environments. Again, not giving investment advice or picking stocks or something like that. And feel free, any of your listeners can reach out to me for this data. But yeah, we would pick sectors based on that. But haven trades in both the stagflationary environment and obviously in a deflationary environment, you look at kind of things like gold. I think gold has the external catalyst, and gold's selling off today. I think gold has because again, I think that was a volatility play and the volatility in the election went down. But I do think that it is interesting. There is just a lot of global demand for that. I'm not recommending that. I don't know your personal situation, but looking at things like that, looking at various things with the fixed income ratio versus the equity ratio, looking at the various aggressions and risks. And now we know that the 60-40 portfolio has vulnerabilities that, we didn't think it had.
Yeah.
And that's the thing that's happening today. Equities are flying. There's more volatility in the bond market. So
Mm-hmm.
it's just all about someone's personal situation juxtaposed to those economic seasons. And then I really wish I could sit here and stock pick with you all day long, but
But it
just not
depends on when they
allowed.
watch it anyways. It could be different tomorrow. So
It
it's
could be different tomorrow. So yeah, it's always at this time. And obviously this is the day after the election. So yeah, so definitely, happy to have that conversation with anybody who wants to, but it's just generally speaking from the global macro perspective, I'm so interested to see, Trump did talk, there was some leaking and rumors, around, is he going to sign an executive order that, where he has some kind of say in what the Fed is doing, right? And
yeah,
I don't know, I don't know whether or not he's looking at that or not looking at that, but may we live in interesting times. It's going to be fascinating to watch. And, based on his first term in office, I'm glad that hopefully the Hitler rhetoric is going to go away just because he didn't, do any of that really in the first term. So, hopefully we
right.
can kind of calm down as a country. I'm looking forward to the prospect of that.
For sure. I agree. Now,
Yeah.
before I ask you about two last questions here, one question is of course, if they want to follow you, what's the best way to do it?
Yeah, so LinkedIn, Frances Stacey on LinkedIn, and I post most of my television and interviews, including this one, on LinkedIn. And then I do have a Twitter. I'm not very good at X or Twitter. That is like a goal for 2025. So give me a couple months to get going on my Twitter game. But yeah, and then I will definitely be posting interviews on Twitter. Unfortunately, not all social media platforms are approved by my compliance, but definitely Twitter and LinkedIn. And yeah, they can, because then if I appear on 10 different networks, and so then they can catch those interviews on LinkedIn is probably the best place.
Wonderful. Well, final two
Yeah.
questions here. The one is, I know in a lot of times the government numbers come out, you hear about unemployment rates. And we were talking about off this air where there's several clients we've had reach out to us saying, hey, I've just lost my job. Yet unemployment still looks amazingly beyond full employment, right? We
Yeah.
also know that the consumer price index has been altered over the years with all kinds of presidencies since Carter. So we've
Yeah.
seen all these alterations. How do you know what to trust when you hear those or when you see those reports coming out? Do you take them with a grain of salt? Do you just say, okay, I'm not even going to listen to this? What do you do?
As a true technical analyst, I just watch the markets. I just watch what the
Mhm.
markets are pricing, what they're getting correct, what they're mispricing. That's what I watch because that at the end of the day, like the Fed can come out and cut rates. And if the bond yields go up, you're not going to want to buy bonds on that rate cutting news. So
Uh-huh.
I just watch what investors are, the markets are very efficient. And, there have been some rumors that they've leaked jobs numbers and certain people found
Yeah.
out, certain people knew. You can't run and hide from technical analysis. It's just empirical data. There's no opinion. There's no narrative.
Mm-hmm.
And some of those, the technical analysis is interesting, like looking at the S&P 500, you had a double top,
Yeah.
you had a new high and then you really had a breakout. And so just looking at
Yeah.
the probabilities that surround those things. Right now I'm looking for the S&P to surpass 5937 to keep its upward momentum
Mm-hmm.
going without like it could get very exuberant around the Trump trade and then have a little bit of a pullback. And then if the market starts selling, I'm looking at 5625 as massive support to kind of keep that upward trend in place. And those are the numbers I'm watching. I do listen to some of the narratives, but I really just look at the vol markets. I look at the open interest in the options market. I look at the 0 days to expiration trading, like what's happening. And I have a few data providers that I follow that try to interpret those internal mechanics. But I'm just looking at what is happening in real time. It's kind of like flying an airplane.
Yeah.
I think this is going to be sunny. No, you have to react to whatever is going on in real time. You can predict
Yeah.
it to some degree, and then you have to be able to react to whatever's happening in real time. And that's how I look at the markets.
I love it. That's great. Takes me back, rather than being a fundamental analyst, you're like, I'm technical, all technical. Those fundamentalists stink, right?
Yeah. I love Abigail Doolittle on Bloomberg. She's like one of my favorite interviews because
Mhm.
she's like such an old school chart woman. I think her name on Twitter is or X is the chartress. And I love talking charts with her. That's like one of my and I do her options insight segment occasionally. Yeah, just because I do think charts are, like fundamental analysis, yes, that is empirical data to some, CEOs are never going to be like the sky is falling.
Yeah.
But the interesting thing is fundamental analysis. So bottom up stock picking versus top down. It just depends on what economic season you're in, right? Because
Yeah.
it's like, yeah, tech stocks for life. Okay, well, tech stocks in the face usually of Fed tightening, usually the rise in the cost of capital usually would affect the tech sector. What's
Yeah.
interesting about what's happened since COVID is that tech, because of all the cash on their balance sheets, have kind of become the safety play and the haven play, which is just fascinating.
Interesting. That's backwards,
So
isn't it?
again, it's like, yeah, internal combustion engine, and you've got this like, and my friend just bought a Porsche, and her Porsche is like a 2020 Porsche, and she's like, the 2024s have like the Tesla panel in the Porsche.
Mm.
So some of these mechanics are changing, but let's see with the credit and the debt cycle. And the business cycle has been around since the Medicis and since the invention of debt and banking. And so
Yeah.
let's just see if the old axle and wheels, and if Elon Musk makes flying taxis, then the axle and wheels are gone. Like, what are
That's
you going
right.
to do?
Then they're obsolete,
Yeah.
right?
And if anybody's going to do it, it's him. I mean, I totally
It's
admire
true.
Elon Musk. So how could you not? Right. Yeah.
Exactly. Well, let me ask you this question. This is kind of the question I always ask on the show because it's the Money Ripples podcast, and we talk about that ripple effect, like I did at the beginning, right?
Yeah.
You know, Francis, what do you feel is really your ripple effect that you're here to do on this planet, or even just on a smaller scale?
Oh my gosh, I love this question. Um, I joke sometimes that it feels like a little bit of a like mental illness to lock myself in a closet for over a decade and study the business and credit cycles. But the
Mhm.
reason that it is my passion is that it affects absolutely everyone.
Mm.
Hairdressers, waiters, now Uber drivers,
Yeah.
executives, bankers. It just affects absolutely everyone how the system works. And the wealth gap is sort of the pernicious thing that, and Ray Dalio has the most amazing data on this, statistical analysis on this, but the wealth gap is the thing that takes a country from a place of prosperity into a place of total discordance, right?
Hmm.
And if you go through history, you have the fall of Rome. Before the fall of Rome, you had this huge exacerbation in the wealth gap. Like 90% of the wealth ended up in like 3% of the population.
Yeah.
Preceded the French Revolution, the same thing. And that is the trajectory that we are on in this country as you have this administration coming in trying to play with these mechanics and really innovate, and Elon's like going to Mars. We don't know how sustainable this whole thing is, right?
Hmm.
Um, so the reason I think I'm on this planet, and I really am, whatever spiritual beliefs people have or whatever religious beliefs they have, of course I respect anybody's, but I do believe that people were put on this planet to do something special. And when you meet people that have tapped into that, and had the courage to kind of follow that, which is not easy. I think I was put on this planet, I think, to change the business cycle so that it just doesn't end up in a wealth gap tragedy eventually over 100 years. And so
Wow.
my work is around changing the algorithms, around changing liquidity ratios and things like that. And with my committee appointment, I have a phenomenal opportunity within the UN infrastructure to reach out to leaders all over the world, 193 countries, and have meaningful discussions about their liquidity issues
Yeah.
and around whether or not they need that the IMF or austerity is their only option, because obviously that hurts people. And we have a
Hmm.
K-shaped economy where people at the top of the K, like even if they lose their job, are probably doing okay. Ray Dalio has delineated this between the upper 40% and the lower 60%. The upper 40% owning assets is probably the point of delineation. And he
Hmm.
wrote something in October of 2017 before COVID. And COVID has only widened this gap, as we know.
Hmm.
And he just was talking about how, that upper part of the K, Americans are living in a first world country. You can look at their growth rates, their lifespans, their propensities for drug addiction, their propensities for disease, access to healthcare, access to clean water, clean food, access to education, and they live in a first world country. If you take the bottom of the K, and that's what I think was resounding in this election, they're living in a third world country. You know,
Mm.
whether they're in a place that doesn't have clean water. Obviously, the quintessential example is Flint, Michigan. And that does, over the iterations of the business cycle, per Ray Dalio's research, cause, eventually it causes these extreme populisms on both the right and the left, and leads to some proverbial, civil war. And I just feel like we're not where Reagan was in the business cycle. Mm-hmm. And I just think mechanically, my prayer is for Elon Musk to like really look like that pilot, look at the present time mechanics and not just try to, like mimic a Reagan era tax cut or whatever, and just really look at these mechanics and how people are totally suffering. And everything follows liquidity. Like you said, the M2 money supply, right? The S&P 500 normally is correlated. I've done some segments on Bloomberg about that with mm-hmm. this liquidity, because you have to have liquidity before you have any of the other things that occur as a result of adding that liquidity. Right. And that's the thing that, the upper part of the K, they win in all 4 seasons of the business cycle.
Yeah.
Because they have talented asset managers that don't just have the buy and hold strategy. And we try to mimic that for any level of wealth. We don't. So we try to mimic that for people so that they are not victims of being retail investors with retail options only. The bottom level of the K, they don't even have assets to invest. They don't even have, they're living that, they have that paycheck to paycheck scenario. So
right.
Changing the system in that way is my ultimate dream. So it's kind of a big one. It's kind of a big one. Yeah.
It is a big one, but it's fascinating too. And no, I think it's I think it's wonderful. There's definitely a ripple effect there. And I can tell you're definitely making an impact, which I love.
Thank you. And I do these podcasts and I do tons and tons of television. And I've managed to, stay in a lot of different networks with a lot of different viewpoints and listeners. I predominantly do CBS, Bloomberg, Fox Business. And, I've done a lot of Yahoo Finance and Cheddar News Nation. I've been on Newsmax a few times. But the thing is that I always just want listeners to walk away with a slightly elevated understanding of anything that I said, so that they can see a headline slightly differently. They can listen to a politician slightly differently. And in that way, engage in a slightly different manner. And it's just moving the needle just a tiny, tiny bit. And I just like to educate people about the mechanics of the system, because that's where, especially in a democracy where you have voters picking these people, it's so funny when I watch this election, I'm like, everyone I talked to on either side was honing in on one issue that they understood.
Mm-hmm.
Right? They hone in on one issue they understand. And I'm like, okay, but if the country goes bankrupt, is that worse than if that one issue isn't addressed for that limited populace? And it is, but they don't understand that issue. So I want to increase that understanding in any way I possibly can, so that we can all make more informed choices personally, but also in our leaders.
You teach people to read between the headlines, right?
Yes, that's what I want to do. That's what I want to do. Absolutely.
Yeah. Well, you definitely did that today, Frances. I really appreciate your time today. So awesome. So much good wealth of knowledge that's there.
Thank you so very much. It's been such a pleasure to be with you. And let's do it again sometime.
Totally agree. Well, if you guys agree too, be sure to like, and even comment on this video, say, hey, let's bring Frances back on for another encore session. But definitely, guys, be sure to follow her. We'll put all that in the show notes for LinkedIn and our Twitter page that you can follow her on. And guys, this is the big thing. It's like, it's not just about, what you're seeing on social media and what you're seeing on the headlines. It's about what's the reality, what's really happening right now. And that's what we're trying to do. We're trying to create that education for you so that you can make better decisions, not just with your money, but with your life. So go and make it a wonderful and prosperous week. We'll see you later.